Great to have your company for the weekly wrap this Friday, the 22nd of January. I'm Jessica Amir, a market analyst with Bell Direct. With the Aussie share market clocked up 1.6% Monday to Thursday this week, taking the market to a brand new pre-pandemic 11-month high. And now the market's just a 5% puff from setting a brand new record all-time high. So what's boosting sentiment? Well, it's a couple of things. Firstly, better than expected US corporate earnings results. 88% of the companies who reported results so far this earnings season have beat expectations, suggesting earnings upgrades are here. And this is important because earnings upgrades support share price growth. Take Netflix, for example. This week, they reported better than expected earnings and their shares rose 16% to a brand new record all-time high this week. And that also helped the broader NASDAQ rise over 4% from Monday to Thursday. Secondly, boosting markets is that the US President and his Treasury Secretary have pledged to keep corporate taxes low until the pandemic is over. Now, this means businesses can keep more of their earnings. And thirdly, this week we learned that the Chinese economy grew 2.3% last year, the only country to grow in 2020. But as for this year, the IMF reckons China will grow by 8%, fueled by industrial production. Now, this is really important because it supports Aussie commodity demand and commodity price growth. And fourthly, sentiment is high in Australia because we're continuing to pump out better than expected economic news. Now, this week, the unemployment data came out on Thursday showing that 90% of the jobs lost in COVID-19 were recovered by Chrissy. Employers added 50,000 jobs to their books last month, and that was partly because restrictions ease and business confidence levels are at record highs. And as a result, the unemployment rate dropped from 6.8 to 6.6%. So where have people been investing the most across the Aussie share market this week? Well, hands down, it's the tech sector, which rose 7%. But broad buying has also been taking place, seeing all sectors pick up except utilities. Now, this is because many are thinking the economy will go back to somewhat normal this year. Now, tech rose the most because the tech giant Afterpay shares rocketed up 12% to an all-time high on Thursday of $149. And just after 5 years of being on the ASX, Afterpay overtook Telstra as the 12th biggest company in Australia. But wait, there's more. Morgan Stanley reckons Afterpay will continue to grow, expecting half-year results to show active customers grew from 11 to 14 million and for revenue to grow to 455 million in the half year. Now, that's 10% ahead of what average analysts are thinking. But if you think Afterpay was hot this week, did you see Zip? Well, their shares rocketed up 31% to $7.36 on Thursday, which meant they were the best performing ASX 200 stock. And investors were also screaming bingo after the rubbish firm Bingo shares rose 21% to $3.29 on the back of a $2.3 billion takeover offer. But let's move to the week ahead. I guess there's a couple of considerations. Firstly, consider the fight and potential upside in the buy now, pay later space. Now, this week we saw Zip shares see a lot of buying. They jumped to their highest level in 22 weeks, or they saw the biggest jump in 22 weeks rather, on the back of better than expected results. But that wasn't enough to recover from September's fall when PayPal entered the sector, whereas Afterpay, the dominant player in Australia and New Zealand, continued to grow scale in the US and Canada. So they quickly recovered from that pullback. But what's really interesting is Zip's app downloads are now outpacing Afterpay's in Australia. That's according to Citi. And in the US, Afterpay's app use is now growing quicker than Klarna. But if you compare the pair, Zip's active customers this week, we learnt, grew to 5.7 million. Afterpay has got double those customers. Zip's revenue grew to 100 million in the quarter. Afterpay makes double that. But what's key here is earnings and cash flow growth drive share price growth. Morgans sees upside in Zip, has got it as a buy with a $7.86 target. And Morgan Stanley has got a buy on Afterpay with an outpaced $136 target. Secondly, consider more broadly that some investment managers were, I guess, sitting on the fence, expecting large-scale civil unrest as Trump handed over the US presidential baton to Biden. But that didn't really happen. So that means extra cash from the sidelines could rush into markets next week because uncertainty has passed. So there could be another rally. And thirdly, consider that new home sales are up 92% in December. That's the strongest level in 20 years. And that the unemployment rate is expected to fall to 6% at the end of this year. That's according to Citi. So you could look at Domain. Their shares broke above their 200-day average price this week, rising to a month high on stronger than expected revenue. Now, Macquarie rates Domain as a buy, a $5.25 target. Or you could look at Elders, which is an agri and real estate business backed by Macquarie and Citi as buys, with targets of $13.98 and $13 respectively. And lastly, banks. They're expected to shine and outperform the ASX this year. That's according to Morgan Stanley. Now, the broker's top picks are ANZ and Westpac, with targets of $26.20 and $24.60 respectively. And that's it for the weekly wrap. Thanks for your company. We'll see you next week with a preview of what to expect ahead of reporting season.